I'd like to welcome everyone logging on to Money Show's virtual expo. We do have a couple of minutes here before the next session begins, so thank you so much for joining us. Just a quick reminder, you have a chat box next to your video player. Feel free to type in any questions as we go. Time permitting, we'll get those questions over to Avi and have him maybe answer a few. So sit back, have your questions ready, and we'll be right back with you momentarily. Thank you for being here. All right, Avi, we're about a minute out. I'm going to go ahead and stop share on my side. So when you're ready, feel free to click that share screen button. We'll make sure everything looks good.
Share. How we doing?
All right, I have the white chart.
Yep, that's the five-wave LA wave structure.
Perfect. Looks
Great.
good. All right, everyone. Thank you so much for logging on to Money Show's Virtual Expo Fixed Income Forum. We are pleased to welcome Avi Gilbert, founder of ElliotWaveTrader.net. He's an Elliott Wave market analyst and author of ElliotWaveTrader.net, a live trading room featuring analysis by a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, Seeking Alpha, and MoneyShow.com. Avi, thank you so much for taking the time out. It's all yours.
My pleasure. Thank you very much. Good afternoon, everybody, and thank you for joining us. Before I actually get into my individual charts, I want to give you just a very quick and brief synopsis of how we look at the market. Whereas I know most people look at the market, based upon fundamentals, economic reports, and so on and so forth, we really look at the market from a market sentiment standpoint. In other words, we view sentiment, societal sentiment, as what drives the market both up and down. Ralph Nelson Elliott came up with the Elliott wave analysis back in the 1930s. And what he identified was that the market basically moves in a five-wave structure during a trend. So five-wave structures are with the trend, three waves are corrective structures. I have a standard five-wave structure that I'm going to take you through here so you can get a basic understanding of what I'm about to show you in the individual charts. What Elliott identified was that the market was fractal in nature, meaning that it's variably self-similar at all degrees of trend. Okay, well, what does that mean? Well, we start with the basic Elliott five-wave structure, and you see Roman numerals 1, 2, 3, 4, and 5, right? You have 1, 2, 3, 4, and 5. What Elliott said when he said it's fractal in nature is that each of these then divide up even further. So whereas 1, 3, and 5 move with the trend, waves 2 and 4 are counter trend. But take note that 1, 3, and 5 subdivide into five-wave structures themselves. And we outline that in just the heart of wave 3, so you could see it. You see Arabic numbers 1, 2, 3, 4, 5 in wave 3. But if we really delve down into it, you would also see 1, 2, 3, 4, 5 in wave 1, and 1, 2, 3, 4, 5 in wave 5. So that's the basic Elliott wave structure. And again, five waves in each of the waves 1, 3, and 5 that move with the trend, and three waves that are labeled A, B, C that move counter trend in wave 2 and wave 4. So I want you to focus on this general perspective as we now move into the charts. We're going to start with the S&P 500. And I'm going to show you a 100-year chart, 100-year plus rather, 100-plus year chart on the S&P 500. And One of the things that that we learn about when it comes to Elliott wave analysis is the third waves of the five-wave structure are usually the strongest, and that's in the general equity market. But in commodities such as gold and silver, it's usually the fifth waves that are the strongest. Why that is, I can't tell you, but you usually see the strongest sentiment during a third wave, the heart of a third wave. The technicals are strong, the fundamentals are strong, everything is strong during the heart of a third wave. And everybody is pretty much on board that it's a third wave. When you get towards the end of the third wave is when you have among the highest amount of sentiment, but you start seeing a significant amount of divergences in the technicals. But let me take you a step back and I'll take you through the five-wave structure we're seeing in the long-term S&P 500. Now, all of this moves into a wave one high that we struck back in 1929, which led to the 1929 crash. So we're going to call that the top of wave one of this very long-term five-wave structure. That means the 1929 crash, which took off, what was it, about 85 or 87% of the market during that 2-year crash, took us down to, I think, 1931 and 1931, 1932, and it bottomed, like I said, about 85, 87% low. So already, I just want you to know, take note, this is paren 1, the top of 29, the bottom of the 29 market crash, paren 2. Now, where is, oops, sorry, that was the market closing. So where is paren 3? Oh, let's keep going up here. All of this is wave 3. And as I mentioned before, wave 3 is most often the strongest move in the equity market. And you can see this has been an almost 100-year move in the S&P 500 that has basically been, for the most part, straight up when you look at it from a 100+ year structure. And this is what a third wave does. Now, the problem that we have living in our time is that we are now coming to the end of that third wave structure. Now, thank God for my job, all I have to do is count to 5. So I know what comes after a 3. What comes after a 3 is a 4. So if we're approaching the completion of wave 3 off of the 1931 low, and all of this is a 5, and this is completing. Remember, I said wave 1, 3, and 5 break down into 5-wave structures. On the long-term trend, we are completing a 5-wave structure now for this wave 3. And we are actually in the final fifth of the 5 of that 3. In other words, we are really coming to the end of a very long-term trend. And when this completes, my expectation is to see a very long fourth wave. Now, why do I think it's going to be a long fourth wave when we saw wave 2 in 1929 to 1931 only took 2 years, but it knocked off 85% of the market? That's not my expectation. I'm not expecting that great a percentage of a drop. However, it probably will feel a lot worse, whereas the 1929 market crash led to the Great Depression. My fear is that this fourth wave of the same degree will lead to the Greater Depression. And let me explain why. And I know that doesn't sound good. Believe me, and I say this all the time, you're rarely going to come across an analyst that prays that they're wrong. I will tell you that every day I pray that I am wrong. Unfortunately, I'm not seeing anything to tell me yet that I am. And that scares me because I have 6 children and I do not want them going through, God forbid, what I am potentially foreseeing here. So whereas wave 2 was 85% straight down, Elliott told us that there's a theory of alternation. that if wave two basically is a straight move down, wave four, and a deep straight wave down, wave four will probably be a higher consolidation, but it will take much longer. So if wave two only took us 2 years, I'm expecting wave four to take us a very long time. Now, how am I going to give you a general idea of timing on that? Let me explain. If you go look here, and you'll see we topped in 2000, the internet bubble, the tech bubble, and then we dropped down for a couple of years down to here. We had a 3 or 4 year rally, and then we had the financial crisis, Great Recession. This, my friends, is an A, B, C for the fourth wave of this wave three. Now, and I'm expecting a larger degree fourth wave. So if this fourth wave took us from 2000 to 2009, 8-9 years, right? My assumption is that a wave four of a larger degree will take longer than that. So my minimum expectation for the wave four that I am expecting to begin once we complete this large degree wave three is probably a minimum of a Fibonacci 13 years, whereas the prior one was a Fibonacci 8 years. My expectation is this larger one would be a minimum time frame of a Fibonacci 13 years. It could be as long as a 21-year fourth wave. And the longer that it lasts, the more pain it will likely cause. That's really how I'm seeing it. And it's because of a number of issues that I'm seeing that will probably be triggered within this long-term bear market that I'm foreseeing. And that is what's going to be happening in the banking industry, which is actually, believe it or not, is setting up to be worse potential than what we saw in the Great Recession and the financial crash. So let's start moving into a little bit deeper analysis about our market. Let's start looking at my larger degree expectations. Now, remember I said the fourth wave of one lesser degree was here. A, B, C, this being the great financial crisis. And then we're looking for, if this ended wave four, so we're looking for the completion of wave five. And that is where we're approaching to right now, guys. You know, I don't know how many of you have followed me for a long period of time, but there are a number of notable points that if you've been following me, you may remember we called for a global melt-up as the market was bottoming here back around 2015 into 2016 and going forward. That was this move here. Now, if you also remember, over here, it was in late 2019 into early 2020, I was calling for a 30 to 35% market drop. I did not expect it would be like this, but that's exactly what we got. And that finished off the fourth wave of this fifth wave. And if some of you may remember, we had a 2,200 target on this drop where I was telling anybody that was willing to listen to buy in a big way. Most people thought I was crazy because we were in the middle of this COVID crash and everybody assumed the world was ending, and I'm telling people to buy. So I will tell you, even long-term clients of mine thought I was crazy. Even my wife thought I was crazy. So, but it was just filling out the pattern. And I know this is why we really don't pay a lot of attention to what the noise that most people do. For example, look what just happened recently. And I'm going to show this to you. I'm going to take a moment and digress for a moment. Okay. Bear with me a moment. I have to redo the scaling on this so you could see it. Okay. Most people assume that, you're going to get a government shutdown, the market's going to tank. Well, the government shutdown here, market ran to all-time highs. Yes, we got another correction, and then we went back again to all-time highs. The government opened here. I don't have it on here, but the government opened, literally it opened at the peak of this, and this is what happened. So this is just one example of, you really cannot pay attention to a lot of what is out there in noise. And that goes for economic reports as well. I could show you study after study that will explain why following economic reports will get you on the wrong side of the market more often than you believe. So we really don't pay attention to what is going on out there. Rather, we look at what is sentiment telling us based upon what the charts are showing us. So let's move back into the monthly chart here. Bear with me a moment. Let's get this. So as you can see on the monthly chart, we are trying to complete the fifth wave of this very long-term third wave. And then my expectation is we're going to go into a very long-term correction. What I also want, so you have an understanding of how my expectation will be for this long-term correction. If you go back to the 2000 high, you will see we had a drop here. We had another a rally here, and then we had a much stronger drop here in a C wave, A, B, C. In the larger degree fourth wave that I'm expecting multiple of these scenarios, whereas the first big move down will be an A wave, then you get a B wave multi-year rally, and then you're going to have a C wave crash. That will be followed by another multi-year rally, could even be as long as a 5, 6, 7-year rally. I can't tell that for right now. And that will be followed by what probably would be the largest crash since the Great Depression. My expectation is the crash that will complete this wave 4 will be much greater than the Great Financial Crisis crash, much greater. In fact, I would assume that the first C wave would probably be akin to the Great Financial Crisis crash, and I would not be surprised if it is accompanied by another banking crisis. I would not be surprised if both of these are accompanied by banking crisis, and that's basically because of the manner in which bank balance sheets are being represented today. They are truly ugly if you dig into them, but that's a side point. So this is the bigger picture. So the question is, have we topped? Are we going to top? How are we going to top? Well, I'm going to say that whereas this structure has been really, it gave us some really great opportunities over the years because the structure was really adhering to what we call the Fibonacci pinball structure, and it was adhering to it so nicely. We were able to call tops and bottoms relatively regularly and very accurately. Unfortunately, this last segment of the rally has taken shape as what we call an ending diagonal. And they are more amorphous and not as exacting as a standard Fibonacci pinball structure that we utilize. So it has made this rally much more complex to track. So let's take a look at our daily chart. And because of the complexity, you're going to see a number of perspectives on here. There are two basic paths that I'm tracking, but before I get into, I'm not going to really get into the highly technical aspects of it. I want to be done with my analysis by 4:30, so I leave plenty of time. I'd like to have probably about a half hour. I'm willing to stay as late as 5 o'clock and leave half an hour for questions if you guys have them. The only thing I'm going to ask you not to ask is don't ask me if something is possible, because the market has an infinite number of possibilities, and we try to focus on what is most probable. So right now, the way I'm looking at it, my expectation is, can we get one more higher high here in the short term? Sure. But I think in the bigger expectation, I think you're going to see us revisiting the 5,700 to 6,000 region. When exactly? Over the coming months, maybe into early 2026. I can't tell you from a timing aspect, but I can tell you the market is likely going to revisit the 5,700 to 6,000 region. The manner in which the market rallies off of that initial decline will tell us if a long-term top is actually in place, or if the market has one more rally to be seen in 2026 before the very long-term top has been struck. So unfortunately, I cannot tell you with a certain amount of confidence whether the market is actually hitting its very long-term top right now. It is going to take the nature of the structure that we see here over the coming months to tell us if the market has indeed struck a very long-term top, or if we have one more rally into 2026. But I will say one thing. If the market has indeed completed a very long-term top, one of the things that we know about in a diagonal is that it usually resolves to the downside in a very, very rapid fashion, and it usually tends to drop back down to the region from which it began in a very rapid fashion, crash-like. So my expectation is once the market does provide us with a top, the initial stage of the decline of the long-term bear market is going to probably take us back down to the 3,500 to 3,800 region. That is my long-term target for the initial drop. This is just the initial drop in the very long-term bearish cycle that I foresee. But we're not there yet. I still don't know if the market has another rally into 2026 or not. And we're not going to know that until we see how the market reacts after the initial decline to the 5,700 to 6,000. But that is a likely scenario that the market will, in my opinion, the market will likely get back down to the 5,700 to 6,000 region. And then it's going to tell us from there how it will progress based upon the nature of the rally off of that initial decline. So in the coming months, we'll have a much better idea as to whether or not we're going to have another rally in 2026 or if the bear market's going to be starting in 2026. That is my larger degree S&P 500 analysis. Let's start looking at the metals because I know a lot of people are always interested in metals. I am going to start with my gold, my GLD monthly chart. Now, for those that have followed me for the last 14 plus years, you may remember one, I think it was the first major market call I ever made was calling for a top in the gold market. And that was in 2011. Everybody and their mother was fighting over themselves about how far the market was going parabolic during that summer of 2011. Everybody and their mother was fighting about how far past 2000 we were going to go. My analysis, which was based upon a 100-year analysis of gold, told me that gold was going to top. I had a topping target of 1916, I think. And we topped at 1921. I think I was like $5 or $6 off. It was somewhere around there. I was about $5 or $6 off. But my expectation, I remember when I wrote my first article about this, and this was during a parabolic. I wrote it in the summer, and people were looking at me, and they had never heard of me before because it was only my first article, first time I made a public call, and people were looking at me and saying, "You're nuts. You don't know what you're talking about." But one person gave me a little bit of room and actually asked me an intelligent question. They said, "Okay, assuming it tops, where do you at 1900? Where do you expect it to go from there?" And I said, well, I think it could probably go back down to the 1,000 region. And once I said that, well, he didn't give me much more leeway after that. He said, okay, you're nuts. And, it just went on from there. Well, needless to say, gold topped within $6 of our target, and it bottomed at 1,050. Those that were in my trading room that night at the end of December, remember, we actually caught the bottom the night it bottomed at the end of December of 2015. In fact, we actually started up a mining stock service in the last quarter of 2015 because a lot of the stocks had bottomed at that point. I remember I bought Newmont Mining at like $15. And my first sale on Newmont Mining was at 82. And then I rebought it back after it crashed a few years ago. So, the manner in which Elliott Wave gives you these turning points, it just astounds me even to this point. Now, I know that people are getting so bullish on gold right now, where they're looking at it and saying gold is now on its way to 5,000 plus, 10,000. I mean, I'm even seeing 15,000. I'm seeing some crazy numbers on gold. My opinion is I think we probably have one more rally in gold. But my expectation is that I believe you're probably going to go back down towards the 2000 region again, maybe even a bit lower. You can even get as low as 1300 again. So my expectation is once we complete this rally, I believe we're going to see a very large bear market again. So don't get too excited, but I believe there is one more rally to be seen. Let me show you on gold chart here. This is the near term. Now, by the way, I want to show you something here. There is some potential that gold may have already topped. And I'm not going to know for certain until we see how it rallies next alongside silver and the mining stocks. Silver, I do not believe has topped. I think the greater likelihood for silver is that it has another rally left that potentially can take it north of 60. But I'm going to have to watch how gold trades during that time to know if it has topped or not. For now, my primary expectation is there is one more rally in gold. However, I think that we may see a very strong decline in gold before that next rally begins. If this high here holds in gold, folks, I think we can get back down to the 3,400 to 3,500 region in gold before the next buying opportunity takes hold and takes us up one more time. So, and depending on the nature of how this rally takes shape will tell me has gold topped or not. If you remember back to 2011, silver topped in April of that year. Gold didn't top until September. It's possible that we may have the reverse in order this time, that gold may have topped. I have enough that I can consider it top, but I am giving it one more opportunity for one more rally before I'm willing to call a top in place. I still think there is a good probability that we get one more rally to be seen in gold. The better opportunity, I believe, is silver. Now, I have been following a fractal from 2010 and 11, and for those that have followed my analysis this year, if you remember in the springtime, I was suggesting that this was going to be an amazing buying opportunity because I see a parabolic rally beginning from here. And pretty much that's what we've seen. I don't think it's completed yet. I think that we are still in a fourth wave consolidation. And from this fourth wave consolidation, my expectation is we can go as high, and this is SLV, by the way, we can go as high as the low to mid 70s in SLV, which probably puts us into the mid to upper 70s, maybe even 80 in the silver futures. So that's my expectation at this time. There's a number of reasons I maintain that region for a target, but I'm not going to go into depth into all the detail of the analysis. I'm just going to give you my overall views on where I think silver can be heading. By the way, I didn't mention in gold, yes, I think there is potential we can get to 5,000. I'm just not sure I'm seeing anything that's significantly beyond 5,000. I need to wait to see how that fifth wave sets up in gold before I could start making some targets like we did back in 2011. So I need to see how the fifth wave sets up. And at that point, I'll probably start coming out with some targets, probably early of 2026. But here, my expectation is I still think that silver can go higher as long as silver in the futures holds the 41 region on the next pullback. My expectation is we can go to minimum of 60, but I think there's a good chance of 70 to 80. Let me show you on silver what I'm looking at. As long as this high holds, I'm expecting us to come down to at least the region from which we began this last rally. But I think there is some potential we can get down towards the 42 region, depending on the nature of the next decline. But minimally, so if you're looking to buy and you're looking to buy between 41 and 45, I think that is a great opportunity to layer into this market, assuming we don't break out sooner over this high. As long as we stay below this high, my expectation is you'll get another buying opportunity between 40 and 45, depending on how this we're looking for a decline of 5 waves, depending on how that takes shape. You'll have an opportunity 41 to 45. And from there, like I said, minimally of 60, but my expectation really, I think you can get a blow off top somewhere between the 70 and 80 region. Again, until I actually get into that fifth wave, I can't make any final determinations. So that is the general perspective that I have in gold and silver. Went through the S&P 500. I think I could start taking some questions now. And usually a lot of good information comes from the questions. I usually get into a little more detail to give you guys some answers. So let's start firing away with some questions and let's try to keep them on point.
All right, no problem. We had one of the viewers, he popped in and he was just asking, was 6550 SPX, is that the key support level to watch?
65.50 right now is the key support to watch for now. Ultimately, once 65.50 breaks, I think we can drop down to the 6100 to 6200 region pretty quickly. So yeah, 65.50 right now is the region to watch.
All right, thank you very much. Another viewer writes in, do you expect a USA federal government debt default? And if so, do you expect state municipalities to default also?
That is a very loaded question. I will tell you this. I am expecting the market to be, over the coming years, I'm expecting still more of a consolidation / corrective rally in the US bond market. But I foresee that that is only going to set up a bond market crash as we look towards the end of this decade. I think in the last half of this decade, we're going to see a significant bond market crash, one like we may have never seen before. So do I think the US can default? The answer is I see it as a very real probability. They may not call it a default. They'll play word games as they always do, but I think there will definitely be not definitely, I think there will most likely be a haircut of government bonds along the way. Why? Well, I think from the fundamental reason, I think everybody, because it's math, if I'm looking for a bond market crash, that means rates are going to skyrocket. If rates are going to skyrocket, and right now, I believe interest is the #1 expense of the US government. And if that expense goes into multiples of where we are right now, you get to a point where you can no longer afford the debt. And ultimately, a write down of the debt will likely occur, in my opinion. Everybody believes you can inflate your way out of it. The answer is, I'm sorry, ladies and gentlemen, the Fed and the government does not have as much control as most people believe. If you look at every single market crash where the Fed has tried to do something, you will see it had gone through multiples. The government and the Fed had gone through multiple stages. 2008, they went through multiple stages of doing this and doing that and they could not stop the decline. If you go back to 2020, the Fed reduced its rates 3 times. And it had, and then in the third time that it was 4 times, and the third time that it reduced its rates, it also threw in a huge amount of QT. The market still kept on crashing. It wasn't until the market actually hit the 2200 region that it finally bottomed and began the next rally as per our sentiment expectations. Alan Greenspan, you may like him, you may dislike him. The man understood markets. But he also understood that the Fed did not have the type of control everybody believed it did. He recognized that the market was run by, I forgot what word he used, but other forces, sentiment forces, waves of optimism and pessimism, as he put it. And he also once said that it's not until the market exhausts itself to the downside. These are the exact words he used. It's not until the market exhausts itself to the downside that it will bottom. He recognized that you had to have a washout in sentiment, in bullish sentiment, and you had to have bearish sentiment taken to an extreme before the market would bottom and turn. So Alan Greenspan recognized that, and that is what we do. We identify where those extremes on the highs and the extremes on the lows really reside. Now, the extremes on the lows, believe it or not, sometimes are easier to find than the extremes on the highs. That 2200 region was really a great opportunity back in 2020. I'm not going to foresee any great opportunities like that for quite some time, for many, many years to come. But that's what Alan Greenspan said. So ultimately, do I think that we're going to have a very long-term bond bear market? The answer is yes. Can it lead to a reduction of debt through a write-down? My answer is yes.
All right, thank you very much. Another viewer is writing in, do you expect the US dollar will no longer be the world's reserve currency? And if yes, when do you expect this to occur?
Well, this is the common expectation about the US dollar. I've heard the US dollar is dead more times than I can count. And because I'm balding, probably more times than I have hair on my head at this point. The last major time we heard this was back here in 2000 well, first we heard it back in 2008, and then we heard it again in 2011. Now, what was going on in 2011? The market was throwing at the Fed was throwing QE at the market like there was no tomorrow. And everybody believed, everybody, their mother, their grandmother, their grandmother's dog, all believed that QE was going to kill the dollar and cause it to crash. We had a very different perspective on it. Back in 2011, I actually put out an article to our analysis, not even an article, an analysis to our clients when we were in the 73 region. I gave them a target of 103.50 something. I forgot exactly what it was, but it was around 103 from the 73 region. I was looking for a $30 multi-year rally in the Dixie. And again, people thought I was nuts because everybody at the time was so certain that the dollar was about to be trashed. We came within pennies of the target that I had for this third wave at 103. What was the top of this 103? I think we hit 103.82. Right. So I think I had 103.53 and we hit 103.82. I think I was off by 29 cents in that multi-year call before we got the next fourth wave that I expected. And then we got this next rally. Now, my current expectation is that we are bottoming in a similar way here that we were here. Here, remember what I said, you have wave one and then you have wave two. Wave two is the corrective structure, and that is an ABC structure. So we had an A, B, C. Great. Guess what we have here? A, B, C. We may get one more lower low or not. I'm not sure about that. That's the one thing I'm questioning right now. If we get one more lower low on the dollar. But should I see an impulsive five-wave structure take us up to the 106 region over the coming year or so, or even higher up to 110, somewhere in here, if I see a five-wave structure take us out of here to here, ladies and gentlemen, that is going to be a strong signal that we are about to see a multi-year, it could be even what I'm looking for is a decade-long rally in the dollar. So where most people are calling for the end of the dollar right now, folks, I'm looking for a sizable bounce at a minimum, but more likely it will be the start of another major multi-year rally in the dollar. So no, I'm not looking for the end of the dollar as we know it right now. So
All
that's the
right, thank
long and
you.
short of it.
Excellent. Another viewer here, there, are you interested currently in any mining stocks?
Sure, I'm interested in a whole bunch of them. But I think that there's a better opportunity around the corner. I think we're probably going to see one more decline, and I think we'll have a if we get that one more decline, I think in a number of them that's going to be a huge opportunity. But because they will, a lot of them vary as to where they are in their current structure. So some will do much better than others. Like I said, we have a mining stock service that just focuses on mining stocks. So, should we get this next decline that I want to see, then I think you're going to have some great opportunities. Not all of them are going to be equal, but you're going to see some great opportunities on some of these mining stocks going into 2026. So yes, I think there's going to be a really good opportunity coming as we look towards 2026 for one more rally in the mining stocks.
All right, thank you very much. Another viewer writes in, if a monetary reset is gold backed, what does that do to the value of gold?
Okay, this is the person who's asking this is no question in my mind, you're a gold bug because this is what every gold bug is praying to see. Chances of it being gold backed is probably low. I think you have a very low probability. So what you're asking me first is, do I see a probability that it's going to be gold backed? And two, if it is, what will happen to gold? I would tell you, you are much better off following the Elliott wave structures of gold than going down this path that you're asking me about. You will get a much more accurate and even more importantly, much more profitable perspective on gold, looking at it from a sentiment perspective than the perspective you are looking at it based on your question.
All right, thank you very much. Another viewer, they ask, what is the forecast for other precious and industrial metals, including platinum and copper?
Like I said, we're keeping to the S&P 500, gold and silver. We're staying on point, guys, because otherwise this could venture off into so many different paths. And I'd rather not. I'd rather not.
All right, thank you very much. Um, we had another viewer here. Do you relate volatility to SPX predictions? What is your view of elevated VIX now?
Uh, I'm going to say it again. Let's stick to the S&P 500 and let's stick to gold and silver. I'm not going to get into a discussion of volatility. That could get very long and complex. Let's try to stay on point, guys.
All right, no problem. We had a silver question on the chart of silver. Are we heading up to the low 50s first and then drop back top to the mid 40s? Is that what you're seeing?
Great question. And the answer is my preference. As long as we do not break below this low that we just struck, my preference is to see a corrective rally back up into the higher the better. Ideally, I'd like to see us with a 53 handle. That's what I'd like to see. So I'd like to see a rally that's going to make people believe that we're going back up to the highs. And as long as we remain below this high, so you'll have in here, if we can get this, you'd have a very low risk opportunity for a short on silver. And my expectations, like I said, minimally back to the top of this box. But I think if we get the full extension that I would expect, we can get back down to the 42 region.
All right, thank you very much. Let's see. I'm just trying to keep us on topic here.
And by the way, if somebody wants to ask about the banks, I'm willing to get into that topic because I think that is so important that I think I'm willing to answer questions about banks. I think that is very important to each and every person within the sound of my voice.
All right, no problem. Um, Question here came in. Do you purchase hard assets like gold and silver bars as a hedge?
Okay, that's, you know, I strongly suggest to every single investor that they actually start learning market history rather than believing in market fallacies. When somebody asks me if they're using gold as a hedge for market volatility or as a hedge for the stock market, it tells me that this is a person who is believing in common market fallacies because that is a common market fallacy. People believe you buy gold as a hedge against market volatility, against what can happen in the market. But when I ask people, well, what happened to gold in 2008? People assume, well, it must have been a hedge to market volatility. Gold went down 33% alongside the S&P 500. What you have to realize is that each asset trades in its own cycle. It just so happened to be that the gold cycle was running concurrently in that segment of the cycle. Gold cycle was running concurrently with the S&P cycle. Now, gold bottomed before the S&P did, but you still lost over 30% of your value in your quote unquote hedge. So my suggestion to you is twofold. Stop believing and stop listening to market fallacies. And two, for your own purposes, look behind the fallacies, see if they're true. Do your own market historical research, and you will see most of the things you are told about the markets are noise and fallacies. As I have a favorite meme that I put out to all of our new members as we get them. We have I think we're approaching 9,000 total members. We have about 8,000 retail, about 1,000 money manager clients. One of the favorite memes I'll put out to newer members is Yoda with the statement, "You must unlearn what you have learned." Unfortunately, and this is coming from, I don't know if you guys know my background. My background is I have an economics degree. I have an accounting degree. I passed the CPA exam. I have a law degree. I have a master's of law and taxation. I was a partner in a large firm where I put together very large deals. I understand economics. I understand business, and I understand balance sheets better than most people. But I don't use them when I look to invest because oftentimes when I first started as an investor, I was just like everybody else, and I was basically investing like everybody else, and I basically lost money when everybody else lost money, and I made money whenever. In other words, I was no better than the average Joe. It wasn't until I discovered the sentiment side of the market and started to look past what everybody would say as what people believe and started looking at market history and started seeing, well, that's not true. Okay, everybody says it, but it's not true. So my suggestion to you is start looking past what you are told all these years and start looking at what historically has the market done. Does that really jive with what your belief is, or are you maintaining a false belief? Along those lines, there is a book I could not more strongly suggest to each and every person that's listening, and that is Robert Prechter's The Socioeconomic Theory of Finance. The Socioeconomic Theory of Finance. It will change your view on markets forever, and it will take you to an honest view of markets, and it will take you out of all the fallacies that you've been brought up with on markets. So I think I just answered that question. So I would not be looking at gold as a hedge to the markets. I would be looking at gold for what gold is doing in its cycle. That's probably the best way I can answer it.
All right, thank you so much. We had a viewer that was concerned with their cash and banking in general. They said, "What do you do with it if the banks start to fail?"
That is the question I hope somebody was going to ask. And again, I'm going to go back to market history. This is why, when I started learning about markets, I first started learning about markets from an economic standpoint, clearly an economics major, accounting, so on and so forth. I looked at it from the fundamental side of the market. But you know, so I learned a lot of market history at the time as well, which is why when I started seeing a lot of the things that people believed in fundamentally really didn't jive with what market history showed me. So I learned a lot of market history. One of the things that I did was I went back to what happened during the Great Depression. And I did a lot of studying as to what happened during the Great Depression. And during the Great Depression, there was approximately 40% of the banks that went out of business during the Great Depression. That means that there was still 60% of banks that made it through. As I'm expecting the quote unquote greater depression, I think we can see something similar, and it could be even worse over the longer period of time. So, is it possible that 50% of the banks can go out of the business? I'm telling you, based upon the analysis we have done on bank balance sheets, the answer is yes. There's a third of banks right now that if we go through a bear market, there is a third of banks right off the bat that are at risk of going out of business. Even today, that's how precarious a lot of these balance sheets look like right now. Going back many years, back around 2016, I started explaining to our clients that, look, it's not now. I'm going to talk to you like Joseph talked to Pharaoh. Right now, we're going to have years of plenty in front of us. But I think we're going to get some storm clouds coming in the mid 2020s was my guesstimation. And we're there now. And I said, well, what I think we're going to be doing is we're going to be going into what I believe will be a high yield deflation, which is something similar to what we saw in Europe back in the 2010 debt crisis, European debt crisis, where you saw rates skyrocketing and markets crashing. I think we're in for something similar, but here in the United States. I think that's what we're going to be seeing. So along those lines, people ask, my clients would ask, well, what do we do? Well, I said, well, we're going to get out of the stock market. We're going to get out of the bond market. Well, where do we put our money? In cash. Well, we're going to put our cash in banks. What happened to banks? So at that point, I started looking for, well, are there any safe banks out there? And oddly enough, we thought about starting a service just focusing on banking. So I hired a banking analyst, and he and I started picking apart bank balance sheets. And if I tell you that it took us about 1.5 to 2 years, it's about 4,700 banks in the United States. It took us about 1.5 to 2 years of analysis to come up with a top 15 list of banks in this country. And we came up with a secondary list in various states, of course, beyond that. But we started ranking banks to what we viewed as the strongest. And these are names that none of you probably heard of. All the banks that you guys have heard of have at least one red flag. All the big banks have at least one red flag. Some have multiple red flags. Some. I could tell you that. I would tell you right now that Citibank and Capital One are probably at risk of being the first of the big banks that are going to run into massive problems. The difference between 2008 and now in banks is that in 2008, the government stepped in and did bailouts. Now we're not going to have bailouts. We're going to have something called bail-ins. For those, again, you market history. Back in Cyprus in 2011, I believe it was, 11 or 13. I think it was 2011. There were two major Cypriot banks. They were both going out of business because of the European debt crisis. One went out of business. The second one, what they did was they converted the bank accounts of their customers, a certain amount of their bank accounts, the cash held in the banks, they converted a certain amount of that to equity of the bank, and they were able to reorganize and save the bank. Now, whereas you thought you had $100,000 in a bank, and at the end of the day, all you were left with was maybe $40,000, and the other $60,000 you now became an owner of a bank that you really didn't want to begin with, you still wound up in a better position than the other Cypriot bank that went out of business. But you're still not whole in the cash that you thought you owned. Most people don't understand when you put money into a bank, you then become a creditor of that bank. The bank owes you the money. It's an IOU, and you're an unsecured creditor, which makes it even worse. There's no assets behind there to back you. So you stand last in line during a bankruptcy. The next phase is going to be bail-ins. So, will Capital One and Citibank be able to do enough of a bail-in to save its bank? Maybe, but I can assure you that the holders of bank accounts in those banks will not be happy. But what you're going to want to look for are safe banks. We have a lot of public information you can go look at. It's a site called saferbankingresearch.com, I think. .com or .net, I forgot. But it's Safer Banking Research. We have a lot of public information. We have we list out the due diligence steps that we go through when we look at a banking balance sheet. And you could use that same thing and review the banks that you have and see if your bank has any of the red flags and so on and so forth. But I will tell you, not only was there was one major issue sitting on the bank's balance sheets in 2008, and it took the banking system down. Today, we have five, or we're getting a sixth right now that's developing as well. And in fact, and this shocked the crap out of me, recently, the Fed actually wrote a publication that said that banks are in bigger danger today than they were in 2007, before the great financial crisis. Banks are in a worse position today than they were in 2007. And the Fed said this, but very few people actually listened. Very few people actually even pay attention to this. If you go on to Safer Banking and you look in the articles, I think our last article was second to last or third to last. Within the last three articles we wrote, we highlighted what the Fed just said. It was about what the Fed said. So you can go read that. These are public free articles. We want people to start protecting themselves, because I think, whereas, like I said, in the Great Depression, about 60% of the banks came through. How many are going to come through in the next phase? I can't tell you. I can tell you that based upon the bank balance sheets today, it's going to happen again. The likelihood of it happening again is high. And I think the potential for damage, it's much worse, especially since the government is not going to be able to do a bailout anymore. It's going to be left to depositors to bail out their banks. So if you have a bank that goes under, it's going to be your money that the bank is going to use to reorganize. Like I said, it's a better result than the bank actually closing its doors. Then you'll get literally cents on the dollar. It's a better result, but it's not the ideal result you want. So my suggestion to each and every person is make sure you're doing due diligence on your bank to make sure that you're not going to be caught on the wrong side of that. That's my answer.
Thank you so much. We had another attendee write in. Banks are seeing some stress in the CRE debt. Does your bank publication recognize the different risks these banks take on? Meaning, are some banks more susceptible to bad assets?
See, commercial real estate is only one of the 5 or now even 6 of the issues that we see on bank balance sheets. And the answer is commercial real estate alone can tank the banking industry. And we are now, as we speak, We are entering a window of refinancing that's starting the end of this year, really starting beginning of next year, all the way through 2026 into 2027. And that refinancing window could be what finally sets off issues in the banking industry. And that's just one of the issues that we see on the book. So yes, commercial real estate is high on our list of red flags that we do not want to see on a bank that we have our money in.
Thank you very much. Are you concerned about the US banks or banks worldwide as well?
Yes, we're concerned about banks everywhere. We've been doing some, for example, we looked at, if you go back, and again, know your history, when the US had its banking crisis, Canada came through amazingly. Its top 5 or 6 banks came through with flying colors. Today, those top banks, the major banks in Canada, look like crap. So, as an example, we don't suggest any of the major banks in Canada. There are secondary level banks that we do suggest. There's one in particular that is based out of Canada that even has branches here in the U.S. that I love. So from a balance sheet perspective, their customer service not as great, but from a balance sheet perspective, they look amazing. We've done research. We've branched out to banks in the Eurozone. And we've outlined some of the safest banks we see in the Eurozone as well. So, again, you really have to do the due diligence on your particular bank to make sure that you're in a relatively safe bank. Now, I will tell you that, you could be in a relatively safe bank and it could crash for another reason. For those who remember SVB, that bank was one of the strongest banks in California, but it crashed because it had one of the red flags was sitting on its bank balance sheets. And what actually, I'm not going to get into what caused it to trigger the issue that it had, but it was a very unusual set of circumstances that was precipitated by one man's ego. Not going to get into the specifics of it, but let's just say, it is possible you could be in a good bank and it still has a problem. And that's why my suggestion is you really have to put your money, you have to segregate your money out to a number of banks just to protect yourself.
All right, thank you so much. Another viewer here, they're wondering, would brokerage firms be safer? So put your cash in one of
Brokerage
their money
firms
markets?
brokerage firms are going to have similar issues because you have counterparty risks, and a number of the brokers will they siphon their money out overnight or various times to some of the big banks that they have relationships with. Again, you have to do your due diligence. Out of all the brokerages, not all brokerages also have public enough information. And this is the issue with credit unions as well. You don't have public information, so you can't really make a due diligence determination about how safe they are. I avoid those. So there is one brokerage that I still have money in. And as long as it remains relatively safe, I will keep some money in that brokerage. But as we move closer to this bear market, I am reducing the amount of money that I keep in brokerages.
All right, thank you very much. Another viewer here was wondering, what's the latest top that the S&P and 500 will experience?
I don't understand that question.
All right, we'll see if maybe they can circle back with that.
But we're approaching 5 o'clock, so.
Yeah, it looks like they're just trickling in.
I'll give it another 1 or 2 questions and then we can call it a night.
So this viewer is saying regarding banks, what about the FDIC insurance?
Well, we have an article about the FDIC insurance on Safer Banking Research. I will say it simply that I would not trust it. if the system is having a problem where you're going to have that many banks going out of business, do you really think the government can backstop it? That's why you're really looking more towards you're going to see bail-ins more so than government back. That's my opinion. I'm not a prophet, I'm an analyst, but that's based upon historical. That's my expectation. I personally am not, pun intended, I'm not banking on the FDIC. But we have an article about the FDIC, a public article on the FDIC in Safer Banking Research. Please go read it. It'll give you a lot more specifics.
All right, thank you very much. Another viewer here, they're wondering when will we see the 52-week high in the S&P 500?
You're asking me for what the 52-week high on the S&P 500 is going to be? Is that what he's asking me? Look, folks, I'm like I said, I am an analyst, not a prophet. I'm giving you my expectations based upon probabilities that I'm seeing based upon the structures that are telling me what market sentiment is doing. I'm not going to tell you that the market is going to hit 7,025 on January 2nd, and then that's going to be it. I'm not a prophet. So, my client, I tell this to my clients so often. You guys give me way too much credit based upon some of the questions I get asked. There's only so much a human being can foresee. I'm just a normal human being. There's only so much I can foresee. And if somebody gives you, I know all these analysts come in with their year-end targets. Excuse my French, that's a lot of bullcorn. It makes no sense to even try to do that. Markets are non-linear. They're emotional environments. I'm not going to get into games.
All right. And what's that? I'm sorry.
We'll take one more question.
Do you recommend buying gold and silver now or waiting?
I don't do any recommendations. Why? Because every single person out there has different time frames, risk tolerances. Everybody comes at the market with different perspectives and issues. Do I think that we're going to have a good opportunity for another buy on gold? Not as much on gold, but more so on silver and mining stocks, which is where I'm focusing. I may do some trading on GLD for the final rally, but more likely in silver and mining stocks. Yes, I think we're going to have a great opportunity for that. Do I recommend that you do it? I don't know how much you own already. I don't know what percentage of your portfolio it is. There's so many factors. I can't tell you whether I recommend it to you as an individual asking the question. I could tell you that I'm foreseeing a likely good opportunity to buy gold if we can get, I've already bought, by the way, I already bought a tranche of aggressive positions here on silver. And I would buy another tranche here if we can get it. That's me. This is a good opportunity, but I'm also going to recognize that I'm probably going to have stops on it. As long as we stay over the 40 to 41 region, that's good. It's a great opportunity. So I think that's probably it. We've moved through 5 o'clock.
All right, Avi, thank you so much for taking the time out. As always, we greatly appreciate you.
My pleasure. And thank you guys for joining us this evening. And I hope I got to as many questions as I possibly could answer. You may like the answer, you may not like the answer, but I will just tell you, I'm answering you as honestly as I possibly can. I'm not telling you what you want to hear, what you don't want to hear, and I'm not giving you any of these market fallacies or niceties. I'm giving you honest perspectives that I'm seeing. So I thank you for joining us.
All right, and we appreciate the transparency. Everyone, we were speaking with Avi Gilbert, ElliottWaveTrader.net. You're watching Money Show's Virtual Expo Fixed Income Forum. That will do it for today. We have another day tomorrow, so be sure to log back on. We will talk to you soon. Everyone, have a great evening.